Alright, so last time we did some forecasting using linear regression in Excel. So now we're going to talk about some other forecasting methods. First, though, I want to talk just in general about where volatility and variability comes from in time series data. So we already did our model of the Dow Jones Industrial Average and found it increased generally, or there was a trend up that was pretty consistent over long horizons of about 6% per year. So if the Dow Jones is increasing by 6% per year, but as we looked at the data, we saw certainly that wasn't a constant thing. It had there were boom cycles and bust cycles, and we had a lot of variability in between. And so in general, when looking at time series data, we often notice that there is variance along multiple time horizons. So we often talk about seasonality, for example, in time series data. And you see it a lot in business data as well. There are certain patterns throughout the calendar year that are predictable and forecastable. For example, it's a pretty regular phenomenon in stock prices that January or December is a tough month for prices. There tends to be downward price pressure in December. And then in January, returns tend to be good. And the general rationale for this is that in December, people who are trading and paying capital gains taxes are looking to realize some gains. So they didn't, or realize some losses, to offset gains. So let's imagine that they made a really great pick in January. It had quadrupled their money in June, and so they decided to sell to lock in the gain. Well, now it's December, and they're worrying about paying tax on all of that gain. So they go and find a couple stocks that have been doing poorly in their portfolio and sell them off real quick in the end of December to capture the loss. And so that way the capital loss, they'll realize the capital loss to offset the gain that they realized. So there's some downward pressure in December, and then when January comes around, these investors figure out what they want to buy now, and so they'll spend on stocks in January and drive prices up. So this is sort of a regular phenomenon in stock prices that happens with the calendar year, and it's fairly predictable. Over long horizons, when we think about stock prices, we think about the macroeconomy. So we have bull markets and bear markets. And the market trends down for a time, and then it will trend up for a while. And these are large and irregular and not necessarily predictable and often related to the business cycle. So our seasonality variation varies along the calendar year, but our cycles variation may have cycles of 10 years or more. In addition to all of that, we have really short-term variation. In the case of stock, we have variation by month, by week, by day, by hour, by minute, by second, by microsecond even. So there's noise along all of those time horizons, and it's not necessarily predictable. And so generally, we may want to take into account, say, seasonality and cycles, but not necessarily noise. So we want to wash out the noise, but retain the seasonality and the cycles and the trend. And so linear regression only does trends. There's no seasonality or cycles component to it. And so we may want to look to different models that take those into account. One solution for the noise, to wash out noise, is to use moving average. So if I take the last n data points, I can take the average of those points, and if there's individual up and down noise in those data, it will wash out. But if there was, say, a cycle and some seasonality there, we may take advantage of the seasonality by taking the average and include it in our forecast while excluding noise. So in our case, if we look at our forecast of our stock prices, we notice that during bull markets we tend to be above the line, and in bear markets we tend to be below the line. And so we can figure out we might do a moving average of the errors in our regression line and use that to take advantage of, say, our understanding that we're currently in a bull market or a bear market. Now, I've got a real simple example here using red and green balls. And the idea is you've got a jar and you've got balls in it, and you don't know how many red and green ones are in there. All you know is that you put your hand in, you draw one out. It's either going to be red or green, and then you put it back. So you figure if you have long enough, if you're drawing balls for long enough, you might have just sort of a general idea of how many there are in the jar. And if I use a moving average, I can wash out some of the uncertainty of just picking an individual ball. So one way to predict how many red balls there are in a jar is to draw the first ball and to say, oh, this ball was green, therefore there are no red balls in the jar. So that would be a model that forecasts including the trend, the cycles, the seasonality, and the noise, which doesn't do very well. Just a second.